Hello, my name is Rob Hay, and I'm Head of Distribution and Investor Relations at Collins Street Asset Management. For those of you who are new to Collins Street Asset Management, we are a boutique, founder-led Australian equity specialist based out of Melbourne. For us, as fund managers, we seek to preserve and grow the wealth of our clients, both now and for future generations. And today I'm pleased to introduce to you our insights from the recent ASX reporting season, where 89% of the companies within our flagship Collins Street Value Fund outperformed consensus. Collins Street Asset Management are contrarian, deep value and high conviction in their approach to Australian equities. And I'm delighted to be able to bring to life to you today some of the insights from those positions. I'd like to introduce you to our co-founder and Chief Investment Officer, Vasilios Piperoglou. Now Vas, how did the flagship Collins Street Value Fund perform during the ASX reporting season? And at a headline level, were there any interesting trends or takeaways for you that came out of the company announcements?
Hi, Rob. Hi, everyone. So for August, the reporting season, the Collins Street Value Fund did have its single best performing month, I believe, since inception. So the fund was up over 19% for the month. So if we had to generalize the market, so I think the All Ords index rose about 2.5% versus our 19%. I think what got me really excited was it was the first time in approximately 3 to 4 years where the small to mid value stocks seemed to have outperformed, especially the stocks where the fundamentals are improving, but on a valuations perspective are pretty cheap. You tend to find that during the August reporting season, there was a bit of FOMO in those stocks and they rose quite well. If I had to generalize, I think the valuation of the market is quite expensive on the market as a whole. I think it's about 34% above the average PE multiple historical. Thankfully, our positions we feel a lot more asymmetric and do represent quite a bit of value. I think a lot of the larger companies on the ASX, they hit a few potholes. From the macro perspective, it is still tough out there. What I found interesting was there were a lot of buybacks announced by large companies such as News Corp, CSL, Telstra, and Brambles. To me, that suggests they're a bit more of a defensive type of play coming in. So perhaps some of the larger companies are looking to support their share prices that were weak post-reporting season by announcing these buybacks. But I guess it does show again that fundamentals do matter. And I guess when you're looking to make an investment, most of the time the margin of safety is acquired upfront in the low multiples you purchase. And so that's kind of generally on a high level what we saw on the market.
There was certainly a lot of expectation coming into a reporting season of those large cap names. And given the market cap of them, how well researched they are by the street, you'd expect the performance to be relatively muted on the day of announcing. What did you see? Was there a lot of volatility, and how did the market respond to what came out?
Yeah, that's an interesting observation. I mean, you would think that the larger companies that have a lot of the brokers and analyst reports following them, you would think they would be priced close to their kind of intrinsic valuation, but we kind of saw the opposite in a few names. So I guess it suggests that perhaps expectations for 26 going into reporting season generally were higher than reality. So we have seen some slight downgrades to full year 26 numbers and profit margins for a lot of these larger companies. Now, I'm not to suggest that we're entering a recessionary period, but obviously, from the business perspective and margins for them to be falling, that there is a question mark on kind of the macro level. And so I think it's interesting that the CSLs of this world had very, very big falls, yet everyone seems to kind of follow these stocks and write about them. So yeah, and then on the opposite, as I said earlier, on the opposite, some of the small to mid caps that we follow clearly have minimal, if any, following, analyst following, and when they did report some good numbers, there seemed to be a bit of FOMO. So yeah, I guess the market isn't always efficient. as they say. And so, yeah, it was the first time in a while where, the small to mids have outperformed.
And where there is that uncertainty, it creates opportunity for those fundamental deep value investors to really roll up their sleeves and do their homework and find those gems in the marketplace. So Vas, on that footing, how are you positioning the flagship Collins Street Value Fund at the moment from a sectoral perspective, and also in terms of a market cap weighting? You mentioned small to mid caps is where you're focused. Is that primarily where you're focused?
At the moment, yes. So whilst our mandate obviously is pretty wide and we can invest across the whole spectrum from market cap size, at the moment we are predominantly seeing the better valuations in the small to mid caps. Obviously, the Collins Street Value Fund, it still has its largest single position is in the gold equities. We have taken profits in the gold sector 4 times. So we've reduced our holdings 4 times, and that's a function of how well they've done. But even though we've done that 4 times, it's still a significant part of the portfolio. And then after that, we do have obviously some concentrated investments in individual industrial companies, and they range from various sectors, from oil and gas to entertainment, entertainment/casino, media, litigation. And so we kind of do have a pretty unique asymmetric basket of investments.
Gold is quite topical at the moment, Vas, and last night it touched 3,600 US an ounce. What's your outlook for the sector, both in terms of the fundamentals of the companies and perhaps if there are more tailwinds still to drive that gold price higher?
Yeah, so I think conceptually, I think there is still a bit to go in the gold thematic. Obviously, from a geopolitical level, and also from a monetary level, if you to believe that interest rates are going down, not up, and if you believe the US Fed will likely or potentially reduce rates again, I know they've got the Fed meeting in about 10 days, and everyone does believe that they will reduce again. And so there's multiple tailwinds to the gold thematic, including the USD devaluation that we're seeing, and also a lot of countries and businesses wanting just to diversify away from treasuries. So the tailwind continues. Obviously, it is a thematic, and we thought the only logical thing to do from a risk weighting perspective is, as it continues and as potentially the stocks continue to grind higher that follow the gold price, it's only logical to slowly take some profits off the table, and that's what we've done. So we're still very bullish. It's still our single largest position, but we are pragmatic when it comes to portfolio weightings.
And there is still quite a disconnect, isn't there, between where the gold price is and where those companies are sitting?
I think so, especially in the small, high quality exploration and development plays. There is still a large disconnect. And if you look at a lot of the substantial shareholdings in these small companies, you're still not seeing the typical fund management names that you would see in a bull market. So that suggests to me that the money men and women aren't there yet. And so, yeah, we think we're still in the early to mid stages of this bull market.
And so for some of those smaller companies that we have in the flagship value fund, Tesoro Gold being an example, what do you see then as the likely catalyst for a re-rating in their share price? And are there some other companies in that space that perhaps have been subject to some activism to unlock that shareholder value in the near term?
Yeah, so I think with Tesoro, or I should say pretty much all gold stocks generally, obviously the rising gold price in itself should be a natural catalyst, but putting that aside, it's normally when they upgrade their reserves, when they announce after a drilling results more ounces in the ground. For Tesoro, I think naturally, should it continue to upgrade its reserves, obviously there's a potential M&A target there with Gold Fields, the large South African gold company. It's the largest shareholder. I believe we're the second largest shareholder in Tesoro. So it's still a micro cap, and there's still, in our opinion, a lot more room to run. If we look at activism or M&A in general, so there has been a lot of companies that we've invested in specifically in the gold sector, where there has been already M&A or there was some sort of activism. So with the activism front, I guess Catalyst is a good example of an investment that we had a convertible note in. Obviously, I won't be able to go into the details of the dispute with the company, but let's just say we and it's public knowledge, the company made an announcement that Collins Street did take them to court in WA, and we reached a settlement, and we were given quite a few shares in the company. We're very
modest there, Vass. It was what, 2.5 million shares?
It was 2.5 million shares in Catalyst, so it was about $16 million. And so, you know, that's one good example of some activism. On the M&A front, the most recent example is probably Araman and Brightstar. So Brightstar made a takeover for Araman, and I think any day now they should probably announce the scheme has been signed and hopefully gets approved by shareholders in a couple of months.
Oh, wonderful. And so for those gold companies that are producing, and we've seen, for example, Black Cat Syndicate throughout the course of 2025 come into production, have they been able to take advantage of the higher spot price of gold? And have they been able to manage their cash flows such that inflation hasn't come in to erode any upside?
Yes, so pretty much the majority, if not all of our gold positions have unhedged books. And that was probably one of the main reasons why what attracted us to the positions we had. So effectively all of them are unhedged. So yes, they do benefit from the rising gold price. Now with inflation, I do believe inflation from a all-in sustainable costs has reduced, and you know, there was a period where it did escalate quicker than the rise in the gold price, but that's kind of mean reverted. And so the majority of the increase in the gold price literally hits the bottom line of the producers, which helps their cash flows. And so yes, that they have taken advantage.
Yeah, incredible. And we've seen some of those companies as well announce that they're keeping some of that physical gold on their balance sheet and not necessarily selling it all back into the market.
Yeah, I think you're referring to Black Cat. Yeah, that was a pretty interesting announcement, and I think the market liked it. And why not? If they are producing enough cash that, you know, and there's minimal debt, and they don't need to sell the gold, and investors invest in gold stocks for gold, or a leverage play on gold, I think it's a great idea.
Yeah, definitely a strong signal to the market. And so that's for those companies in the fund that do have earnings and had their announcements come through in August. What can you tell us? What were some of the interesting parts, the wins and the losses? You know, not too many losses, nearly 90% outperformed. If we perhaps kick off with Boom Logistics as a good example.
Sure. So Boom Logistics, just some of the highlights. Obviously, the revenue growth of 2% to 264 million. Underlying NPAT was about 9.3 million. EPS was 22 cents a share, which was a 38% increase from PCP. The good points, obviously, very, very strong profit growth. Another good point is they did benefit from a lot of renewable and infrastructure spending. And so, you know, the industries that they are reliant on for the revenues are pretty counter-cyclical. It's fair to say, regardless of economic activity, renewable and infrastructure spending seems to continue to be on the up. Another positive is they did reintroduce the small dividend. So they paid a small 2-cent unfranked dividend, but more importantly, they announced a $4 million buyback. And unlike most other buybacks that other listed companies announce, I think Boom will actually buy back all $4 million worth. And if you look at the current market cap, it's about 7.3% of outstanding shares.
That's substantial.
So that's the good news. The bad news, now I think one of the bad news was post-reporting season. That was the CEO, I believe, was stood down. And another, I guess if I had to find a negative point on that the revenue growth was modest. There was only 2% revenue growth, but 38% increase in earnings. So technically that's modest revenue growth, but it does tell me that they're only chasing profitable business, which really is what you want all businesses to do.
But to put this into perspective, Boom Logistics have had quite a track record of profit upgrades in recent times, haven't they?
They have. I believe, from memory, they've had about 7 profit upgrades in a row. Yet the shares are still in our opinions, pretty reasonably priced.
Absolutely, and that buyback is certainly a sign of confidence from management and the board in where they see that business going. So to change tack bats and to go into a different sector, Seven West Media is also a large holding in the fund. What can you share with our audience about that?
So Seven West Media revenue growth was -4%. The EBITDA was 159 million, or underlying NPAT was 57 million, or EPS of about 3.7 cents per share. Now, based on the current share price, and we think EPS will be flat or slightly increase in full year 26, but based on full year 25 numbers, that puts it at PE of 3.9 times. So yes, that's a PE of 3.9 times. Net debt is 287 million. The leverage, so debt to EBITDA, is only 1.8 times. So the good points about Seven West at the reporting season, so obviously improved liquidity, reduced debt. Their digital growth was good for their digital channels. Costs were very much under control. And I think this is what the market missed. And certainly we didn't, but obviously in the short term, the market can be irrational. If you separated the first half and second half of their numbers, so when they report full year, clearly it's the 12 months, but they did in one of their slides separate first half to second half. It was the first time, so they had second half profit growth from PCP, and so that was the first time, I believe, in 3 to 4 years where they actually had growth in their advertising business. So that suggests to me that A, it's not in structural decline, and B, we are seeing the green shoots in the advertising recession that's happened in the last 3 to 4 years. So they were the good points. I guess if you were to look at some of the negatives, they still haven't reinstated the dividend. So there is still no dividend in Seven West Media, but I'd like to think for full year 26, so within another 12 months, they should hopefully reinstate some dividends. And so, yeah, that's kind of Seven West on a high level.
They have been able to pay debt, as you say, pay down $16 million worth of debt at a point where we're very much at the bottom of the advertising cycle. Things are only really starting to point upwards from here. As a company, what multiple is Seven West Media trading on? How does that stack up compared to some of the other names in the market?
So Seven West, yeah, it's trading on full year 25 numbers. So if you assume flat earnings, even though we think it's going to go up slightly, but assuming full year 25, it's trading on a P of 3.9. So that's very cheap in any industry, in any number, in any media sector in the world. So it's at least half of the other multiples of some of the other domestic media companies. Now, obviously, Seven West Media isn't a huge growth story, but you would think 3.9 is pretty cheap, and effectively from our intrinsic valuation, even if we applied a very respectable 8 times PE, you know, there's some significant upside from where it's currently.
In terms of PE multiples.
Yes. So I mean, the All Ords, the average PE is above 20. So again, if you just use 8 times, it's very asymmetric.
Okay. And so Sky City Entertainment is one that's been in the media recently. How did you feel about their announcement, and what's your thoughts on this company?
Slightly bittersweet. I'll start with the sweet. So everyone knows that casinos in Australasia have been doing it tough recently, from regulatory changes and also increase in costs to beef up compliance and regulation. And so on top of that, the New Zealand economy has been in a pretty brutal recession for the last couple of years. Now, it is showing green shoots at the moment, but so overlaying that, the fact that their revenues only fell 5%, I thought was pretty good. So their revenues came down to 825 million New Zealand. Their underlying NPAT, obviously they have a lot of fixed costs, so the 5% fall in revenues does fall a lot to the bottom line. So their net profit after tax came in at 71 million New Zealand. Now, that was above our consensus. We thought it would come in about 60. It was certainly above the analyst consensus. And so, you know, we were pretty happy with the business, considering the tough macro factors. What was bitter was management at the same time of the results announcement announced a capital raise. We felt that the capital raise was not necessary, so they raised approximately 240 New Zealand million dollars in a new share issue. Now, we feel if you add up a lot of SkyCity's assets, which include assets that we think can easily be sold, whether it's buildings, whether it's casinos, whether it's car parks, whether it's the Sky Tower in New Zealand, you know, a lot of their assets can be sold. They are tier one assets. They do have monopolies in various jurisdictions, and the fact that management announced a very dilutive capital raise didn't sit well with us, especially when there were green shoots, and so yeah, that's one that we were pretty disappointed with, and I believe on record the largest shareholder was Alan Gray in SkyCity, and on the record in the papers they were pretty outspoken on you know, this, what they consider a very poor capital move by management.
Very true. Of course, there are some interesting growth drivers behind SkyCity as well, with the New Zealand International Conference Centre in Auckland coming online. So what sort of, do you view this as transformational for the business? And how can this really ramp?
It is. I mean, let me quote a figure. So the NZICC, which is about to be open, so the construction cost for that whole facility was, I believe, above 700 million New Zealand. Okay. So that's just one convention centre. Now, granted, it's going to attract a lot of millions of visitors a year, and hopefully those that come for the convention stay and spend money in the casino complex, whether that's for food, beverage, or entertainment. It would also help utilisation rates and increase margins in their hotels. So naturally, it will certainly be a positive effect on earnings. But if that convention centre alone, the total cost was 700 million, and that's just the convention centre, that's not the casinos, that's not their other assets, versus a market cap that's similar, it just shows how deep value SkyCity is. They've also introduced in New Zealand carded play, so they've removed cash for gaming, and early indications are that it's not having a material impact, because the SkyCity New Zealand never really relied on high rollers. It was as more of an entertainment complex, and so yeah, we think it's amazing assets. They do have a monopoly in Auckland and Adelaide, and considering you know, the bottom of the cycle earnings for a casino operator, you know, we're pretty bullish that stock at these levels. Granted, we still think the capital raise was not the right decision.
Okay, understand. So one more company to go through that. Tell us about Hum Financial Group. They've had some interesting back and forth in recent times.
Yes. So Hum Financial Group, we used to be known as Flexi Group. They had a pretty good result. So revenues were up about 8% to 666 million. Underlying NPAT was about 55 million, which was effectively flat from PCP. If you look from a PE perspective, it's trading at about 5.8 times PE. The business has strong liquidity, has undrawn finance facilities, has over 125 million in unrestricted cash on its balance sheet, versus the market cap of 320.
They've got a fair franking balance as well.
They do have a large franking balance as well, and so the business model is pretty resilient. Their net interest margins are pretty stable. I guess that's the good points. The bad about Hum is there's a bit of a conflict. The chairman and the founder, Andrew Abercrombie, indicated that he was lobbying a lowball offer to take the company private. It was indicated he offered around 59 cents per share. The shares are trading well north of that at the moment. in the results, they did indicate that Andrew Abercrombie may lob the formal offer mid this month. And so, you know, the numbers that are quoting for this potential takeover are very low. And why we're a little bit disappointed is not the fact that a founder and chairman wants to take the company private on cheaply, but the fact that a few years ago there was an offer by Latitude Financial for their consumer division, and the offer price for just that division, which excluded obviously their commercial division, the offer price, if you had to look at a cents per share, was well north of the current offer price for the whole business. And Andrew Abercrombie, I believe, in the public domain, was quoted in various media articles saying that Latitude's offer should be rejected, and it was very opportunistic. It's ironic that it would seem that that's what we're currently witnessing as well.
All right. And so that's reporting season can often bring up as many questions as it does provide answers. What are some of the areas of research that you'll be looking into over the coming months, and where to from here?
So I guess where we're honing in on the potential opportunities is normally post-reporting season. You know, as value investors, we get really attracted to, you know, the better quality companies that potentially got sold off. And so without mentioning some names, there are some what we believe high quality brands. One of them is in the quick service restaurant sector, where they have been sold off quite heavily. And so, you know, we're trying to uncover some of the gems out there, and effectively that means, you know, going back and doing primary research. So, for example, for that particular company, Stephen, who is our analyst, and I will probably be traveling to Perth and knocking on a few doors there. And so, yeah, look, conceptually, there is value. You're going to be very stock specific, but what gets us excited is not necessarily, Rob, the new ideas, it's our existing positions. You know, most of the positions we've had in the value fund have been there for a couple of years, and it's literally only now during this reporting season where the market is slowly waking up to the fundamentals. And so, you know, a lot of our existing positions, you know, if we look at some of the stocks, whether it's Boom Logistics, Emeco Holdings, we spoke about Hum, the turnaround strategy at National Tyres. You know, some of those stocks, and Seven West Media, you know, some of those stocks are trading at half, sometimes less than half the market multiples. You're seeing green shoots, strong balance sheets, profit upgrades, strong cash flows, buybacks. You know, we're pretty excited, and I guess fundamentally, you know, if we think about macro factors and macro overlays, a lot of the companies we are looking at and that we're already in, we feel are pretty resilient to inflation. So if inflation does come back, you know, we think a lot of the businesses we're in have pricing power or have assets that can be pretty resilient. And so we're not really exposed much to you know, the discretionary sector, and so yeah, we're pretty excited that, you know, the small to mids are slowly catching a bid, and you know, that's the main reason why we had our single best performance since inception.
And certainly where we within the fund are seeing our portfolio of companies trading at approximately half of our assessment of their intrinsic worth, it does provide substantial margin of safety up front, and some fairly exciting opportunities for growth in the unit price as well, as we saw during the month of August. So by way of summary, during the reporting season, nearly 90% of the companies within our flagship Collins Street Value Fund beat consensus. And this is very much a result, as Vas mentioned, of work that wasn't done in the last month or the last 3 months, but of being able to do the research over the years and having the patience to see that come through and be expressed with conviction over time. If throughout today's webinar, we haven't had the opportunity to address the questions that you've asked, We will be reaching out to you over the course of the coming days and would be more than happy to have a chat if you'd like to reach out to us. Thank you, Vas, for sharing your insights with us today on the ASX reporting season. And thank you everybody for joining us on today's webinar.